áudios a partir de agora.
Good afternoon, good evening, or good morning, everyone. It's a pleasure to welcome you to the PwC Debate Tax Policy webcast. I'm very pleased to have here with us a host of star presenters. We have Pam Olson from our US firm, former head of our National Tax Services unit, Meili Franco from Alston, head of tax for Latin America. We have Bruna Ferrari, head of tax and legal for Klabin. I'll let them introduce themselves and their companies later on. We're scheduled to have Patricia Lopez also from Yoshpi Maxion. She's trying to connect. This happens in some of our live transmissions. And I am Romero Tavares, partner at PwC Brazil, head of international tax here, and part of our global policy group. I'll kick things off really quick and just ask Pam to provide us an overview of the latest and greatest, or not so greatest, developments in U.S. tax policy. We will try to draw a broad picture. First of all, I do hope everyone is safe and sound at home or at work in wherever country you're in, following the guidelines for social distancing or not. Perhaps in the U.S., in some of the places with their masks off, hopefully. But for those of you who are still like us in Brazil, going through a tough moment in the pandemic, our hearts go out to you. Stay safe, you and your families. And this is the big trigger for this webinar. We are still living through this health crisis and financial crisis. We're still having investments throughout the world by different levels of government, both to help with the emergency measures needed triggered by the pandemic, but also to try to stimulate recovery and at the same time dealing with the budgetary pressures that come from all that has been spent already, the trillions of dollars that we keep hearing announced again and again and again in the US, and we've heard similar numbers for Europe, and we see what's going on with the budget in Brazil, in India, and all other places around the world. And we are, of course, absolutely cognizant of the fact that this will not be solved only with public debt. We will end up having the need to increase tax revenues everywhere, one way or the other. And this is the point we will explore today. What will be the avenues? What is being discussed right now? How does all of this fit into the OECD discussion on the digital taxes and the unified approach on Pillar 1 and Pillar 2? How does everything gets influenced by what's happening in the US? And vice versa. We will try to cover the whole world in this 1 hour and a half. We're ambitious in that goal, but we do hope that with this stellar team here of guests that I'm pleased to welcome today, that we'll be able to do that. So with no further ado, I'll pass it on to Pam.
Thank you, Romero. Hello, everyone. It's good to be with you. I'm sorry we're not there in person, but good to be able to chat with you and look forward to the discussion that we'll have and any questions that might come out. So I'll do a quick overview of what's been proposed by our still relatively new president, Joe Biden, with respect to taxes here in the U.S. It is a dramatic change that he's proposing from what we did during the Trump administration less than 4 years ago. Quick overview at the corporate level. The first thing is a change in the corporate rate from 21% to 28%. If you were paying attention to what we did in the U.S. back in 2017, you know that what happened was a lot of base broadening. So it wasn't just a 21% cut in the rate, but it was a lot of base broadening that went along with it. That meant that the cost of taking that rate from 35% down to 21% was much smaller. So that's the first big thing. The second big thing is a lot of changes on the international side. So with respect to international, one of the things that was included in the 2017 Trump administration legislation was a minimum tax known as GILTI, which stands for global intangible low taxed income. The first and only minimum tax of its kind in the world, still the only minimum tax. It effectively taxes, because of some of the complexities of its provisions, it effectively subjects companies to a tax of at least 13 1/8 on all of their foreign income. As a practical matter, it's very complicated, but companies oftentimes end up paying the full 21% rate and then still owing some GILTI on top of it. So it's a very complicated provision. It operates on a global basis. There is an exemption for the return on assets in foreign countries. So, for example, if you had property, plant, and equipment in Brazil, you would be entitled to a 10% return on that property, plant, and equipment before there would be any top-up tax in the U.S. There was also so I should stop and say how President Biden proposes to change that. He wants to take it from being a globally computed tax to a country-by-country computed tax. The theory being that when you do it on a global basis, there's too much that is allowed to escape from taxation. So that's the first change. He also wants to move the rate on the tax up. So instead of it being 10.5 nominally, 13 1/8, when you take into account the limitation on foreign tax credits, he would take it to 21%. As the nominal rate. And then again, with the denial of the foreign tax credits, it would be over 26%. So a very high minimum tax rate. He would also get rid of that exception for the return on fixed assets. So it would be a much more stringent regime than the regime that was included in 2017. Then there's a tax that was also enacted in 2017 called the BEAT, which stands for Base Erosion and Anti-Avoidance Tax or Anti-Abuse Tax. And President Biden's proposal is to repeal the BEAT and replace it with something called SHIELD, which stands for Stop Harmful Inversions, and I'm forgetting the rest, but low taxed something. Low tax developments and low tax developments. That's what the rest of it is. And so it's not entirely clear how this provision would work. In some senses, it might be a little bit more rational than the BEAT, because although the BEAT says it's about stopping base erosion and only abusive base erosion, as a practical matter, it hits payments out of the U.S. that might be subject to full tax in another country. So it's a little irrational in that regard. It also denies the use of the foreign tax credit and denies some use of some other credits. So it hits companies in kind of strange ways. So some of what President Biden's team have proposed would rationalize the system a little bit, but we're still missing a lot of details on exactly how this would work. One of the things that was quite common in the U.S. before 2017 was inversion transactions, where companies would look for ways to move their corporate headquarters out of the U.S. in order to escape the U.S. tax net. We refer to those as inversions because they oftentimes happen by a subsidiary being formed and then flipping the structure of the corporate group upside down. So inverting the group. But so the Biden administration realizes that what they're proposing is going to be so stringent that they may have companies trying to escape the U.S. tax net again. And so they want to strengthen some of the rules that prevent that from happening. Those are some of the main provisions there. There's also a proposal to get rid of what's called FDII, foreign derived intangible income. There's an exception from that in both from the regular rules, whether it applies to amounts that are or to production in the U.S. that's exported, or it's production outside the U.S. that would otherwise be subject to GILTI. There's an exclusion for that. And President Biden's team proposes getting rid of that as well, but perhaps replacing it with some R&D kinds of incentives that would be focused more on wages than on returns on intangible investments. And then the last thing I'll mention is that there's a proposal for a book income tax. So you'd look at the difference between what a company reported on its tax return and what it put on its financial statement. And whatever that difference is, multiply it by 15%, and that would be an add-on minimum tax. So it's sort of, there's a lot of complaint in the US about the fact that companies report a lot of financial statement income, but then don't report a lot of taxes paid to the United States in particular, but also to governments around the world. And so a desire to make sure that every company is paying at least some minimum amount of tax based on their financial statement income. That one does not appear to be attracting a lot of support on the Hill so far. So that's a quick summary of President Biden's proposals.
That's very good, Pam. It's fascinating. But the key question that is in my mind is how realistic is all of this? When we think about, what's going on in the U.S. Senate committee, what's his name?
Ron Wyden.
From Vermont, yeah, and right, and also
Sanders, yeah.
mentioned,
Manchin,
right?
Yeah.
The conservative Democrats. How much appetite will they have for an increase to the rate, for example, from 21 to 28? How realistic is it that we might end up somewhere below 25? It's one of my first questions. And I'll let you comment on that before I ask you a little bit more about those crazy acronyms, the guilties and the shields and the beats.
Okay. So yes, we really haven't heard a whole lot in terms of specifics from the moderate or conservative Democrats like Joe Manchin. He has been pretty vocal in saying that he didn't think that the tax rate should go above 20%. He's waffled a couple of times. At one point he said, well, it should be at least 25%, but he's also said that it shouldn't go any higher than that. So we're kind of assuming that the top that the rate is going to go to is 25%. But that's still in the category of to be determined. It's interesting. Even the most ardent supporters of President Biden on the Finance Committee, Ron Wyden, who's the chairman of the committee, has put forward some proposals on the international side, and they're not as draconian as the proposals that President Biden has put out. So even on the liberal Democratic side, they don't seem entirely on board with President Biden's approach.
Right. So it's very interesting because once the Made in America Biden plan comes out, and with the stellar team of academics that he's put together and all the announcements about perhaps again, not being insulated anymore. The whole change of administration, right? We're not the Trump nation anymore. Now we're going to be multilateral, right? We're going to play nice with Paris. We're going to try to converge and find multilateral consensus. When I think about that and I see what guilty has at least tried to do, it's a striking resemblance, of course, with what the outcome of Pillar 2 might look like, but with some significant differences. So there is clearly an approximation there. I wanted you to comment on that. So meaning, how realistic is it that guilty will get worse? Or how influential do you think, I think a lot, but how influential do you think that guilty will be in the final design of Pillar 2? And then most importantly, does it mean that the compromise now that the US is trying to strike is forget about the DSTs and Pillar 1 and Amount A, forget about all of that, and let's just settle on what's below the belt line, right? So what can you not do in terms of how low can you go? So end the race to the bottom via guilty and CFC, whatever you like, but let's not go towards the top line type taxes. Do you see it that way as well, Pam? Can you comment on guilty?
Yeah, so I do think that guilty looks a lot like what the OECD has put forward in Pillar 2. The big exception is the country by country exception. Right. The fact that the U.S. does it on a global basis, and the OECD's proposal is to do it on a country by country basis. So that's kind of the biggest thing. I don't see Pillar 2 moving. So what the Biden administration wants is to have a 21% global minimum tax. And I think they've acknowledged that the U.S., they want to put the U.S. in the spot of having a 21% minimum tax, but they're okay with other countries not going up quite that high. But if there's a huge gap, then it's very, very hard to sell that in the U.S. and certainly hard for U.S. companies to take it. But so, the rate, the country by country, there were some objections that we heard from other governments early on about our Q-buy exception from GILTI, but now something like Q-buy seems to be a pretty firm part of the Pillar 2 discussions. So I think when all is said and done, Pillar 2 will probably look quite a bit like GILTI does right now, except for the global versus country by country part.
Right. And it's, for Brazilian multinationals, and we have at least Bruna representing a few that she's been through in the past, and hopefully Patricia will join us soon. But again, it's a scary resemblance to what Brazil does with its full inclusion rule and no minimum. So it's pretty scary. And we deal with some basketing issues there. It's not rest of the world versus Brazil. There's different ways of putting entities together or not, which can be insane and can be really harmful to competitiveness. And I've always seen the debate in the US Congress, good, bad, or ugly, but being a bit broader than just the technicalities, right? So at some point, you will have Democrats talking about what impact that has in the US economy, for US firms, and so forth. So that, at least that gives me some hope, which is also part of what I wanted to ask you about BEAT versus SHIELD. And again, the whole point of the acronyms. Now Europe is going for an acronym too. It's trying to get back to CCCTB. They're putting a cute name to it as well. But on BEAT versus SHIELD, one interesting point that at least appeared to me, I wanted to see if you think about it that way as well, is that part of the narrative for GILTI and BEAT was we're going to establish, we're going to level the playing field and avoid games with GILTI, but we're going to avoid, the inbounds from ripping the US base off with BEAT. But in the end, it doesn't have a carve out for US parented firms. So you may end up having the BEAT beaten up, not foreign inbounds, but US firms. And then when I was reading SHIELD, good, bad, or ugly, at least it tries, in my first reading, to make that distinction. It's a bit more targeted towards foreign parented, isn't it?
It is. Now, there are some American companies that like BEAT because it does protect them from foreign competition.
Right.
And they would prefer to keep.
It's a trade barrier.
Yeah, exactly. And they would prefer to keep BEAT rather than move to SHIELD. But I think that one of the interesting parts is that although a lot of people thought of BEAT when it was coming in as aimed at foreign companies, it was pretty clear to a lot of us looking at it that it was not going to be, that it was going to be aimed at anybody that was producing outside the US and then trying to sell their product into the US. And of course, there's the cost of goods sold carve out. But yeah, no, it's definitely. But so SHIELD, who knows what it's going to look like. My fear about it is that a lot of the features of BEAT ended up being really, really stringent because they were trying to raise revenue from it.
Right.
And when you try to raise revenue, I mean, you know this well as an economist, you end up with a lot more, lot of provisions that you would as a policy matter not include, things like the limits on foreign tax credits. And so my fear with SHIELD is once they get into it, they're going to realize that actually BEAT was raising a lot more revenue than they thought. Right. And that's going to be gone under the SHIELD unless they start.
How can they part with that now, with the budget impact that we're getting from COVID? Now, final point on SHIELD, do you think that would that have a shot at reaching COGS? Because we did get the carve out for BEAT. Would the foreign parented firms have a SHIELD COGS carve out? That would be a big hole.
A very good question. A very good question, because of course the focus up until the Biden administration put its proposals on the table has been on capturing things that were that would clearly constitute base erosion, that would clearly profit shift. But the proposals that the Biden administration are talking about are not about profit shifting. They're about production shifting.
Right.
And so you could very well see them. So, the BEAT is designed to only hit the IP part of payments, not to pick up cost of goods sold. But, once we move to SHIELD and if it's more targeted that way, especially if they raise more revenue.
Yeah. Then it really becomes a trade policy tool beyond services, beyond trade of services, right? Becomes a real trade variant, right?
Yes.
So Pam, I think with that, well, I mean, that's a wonderful start to our debate. I hope that with this quick overview of what's in the pipeline, or not, but at least what's in the pipeline for Congress in the U.S., we will have our participants here and also the audience, raise questions that will help us explore what these potential ideas coming out of the U.S., what impact they might have around the world. I clearly see a link to Brazil, but before we get to Brazil, we're going to have a quick tour around the world, starting in Paris. I mean, at least virtually we can do that. I mean, we're in Brazil, cannot travel anywhere right now, but at least through video we can. So really quickly, I mean, the point I wanted to cover before we hand it off to Mei Li, Patricia, and Bruna are really the shockwaves that this sends out, that the U.S. plan and the Biden administration sends out around the world in terms of international measures that might be acceptable, that might be deemed acceptable. So the U.S. leads by example. Whether you like it or not, what happens in the U.S. influences policy everywhere. And even proposals that might not ever take off and become real, they might not get approved by the U.S. Congress, they are influential. They're picked up by foreign stakeholders, policymakers, and they can have an influence. At the same time, we did have the inverse movement, right? The U.S. was insulated to a great extent, and we had all this great work, actually, great, at least conceptual work, being done out of Paris, through the OECD with the different countries together, sometimes agreeing, most of the times not. Very hard to reach consensus, but at least a lot of the right questions were being asked. If they were being answered properly, I don't think so. But, it's half the knowledge, right? So at least most of the right questions were being asked. And in that sense, I do see that even though there were hopes at the OECD Secretariat, at least, and very openly so, that now we would really be reaching the consensus that was being sought over the last few years. I actually viewed that with a lot of, not a pinch of salt, but with a lot of skepticism. The reason why is, again, I don't think people understand how the U.S. democracy works. So the fact that whatever comes out of Paris, even if the Biden administration sign off on it, which I don't think it will fully, but even if it does, even if there's an agreement reached behind the scenes so that there's a big kumbaya being sang out of Paris and everybody agrees to something, whatever that something is, will be completely scrutinized in Congress and might be completely slaughtered, right? As a famous US politician used to say. So we don't know really if whatever comes out of Paris will materialize in the US. But the point is that whatever comes out of Paris is likely to materialize or more for be copycatted throughout the world, be it within the OECD world or beyond. What I do believe, and this is a point I wanted to make here and then test with our participants, because they actually have firms that operate everywhere in different segments. We're just the service providers, but these guys produce and have plants and do things and sell things, and also are even digital as they do that. So they are actually the target of a lot of these discussions and measures that we try to contribute and shape. So my point is, the way I see the lack of consensus going on Pillar 1 is that we have produced enough. Paris and the European Union has produced enough language and narrative around what Pillar 1 was trying to achieve to really fuel the unilateral measures everywhere. So in a way, it's almost a contradiction, right? The whole point of the effort was to reach consensus so that multilateral measures, or unilateral measures wouldn't need to be adopted. But in producing so much narrative and so much content in trying to reach consensus, you have fed the beast in a way, and you have provided a lot of weaponry and a lot of ideas to different countries around the world to do different things. And if we don't reach consensus on Pillar 1, especially on Amount A, but the narrative is still there, it's still documented in plenty of publications by the OECD, it's quite clear to me that the political narrative of this is fairness, this is a game that is trying to be won by governments. If governments don't agree, it's because they're protecting their own firms. That narrative can still be used or misused in a lot of places. So in a way, it can bite back. I also see it as follows. I mean, with the digital taxes, right? We've talked about this a few times, Ben, you and I. But as that debate gets fueled, and it was, and if there's no real consensus on, especially Amount A, on Pillar 1, marketing intangibles, etc., and you end up with some principled, perhaps, narrative on Pillar 1, but really with something more tangible on Pillar 2, and that is the justification for even OECD members to really pursue whatever principled narrative is put out in Pillar 1, then you really do have this multiplication of levies, which would be seemingly according to whatever consensus, high-level consensus is reached, that can be really distortive. So this is a point that really bothers me in the debate as we talk about raising revenue post-COVID. Let's be clear about who we're trying to raise revenues from. So if we are talking about a recovery period and we're worried about, the economy in different countries picking up, are we clear that most likely we might be taxing consumers? Depending on, of course, there's a variant of economic incidences in every subsector. But for the most part, the richer in intangibles a firm is, the more it has the equivalent of a monopolistic ability to set prices. Consumers will buy because there's nothing else to buy. You're not going to quit using Google because it got a few cents more expensive for the advertiser. But my point here is that you may end up really seeing this narrative serving to promote a shift of the bill from the pandemic to consumers or to labor in a way that wouldn't really fly if we were having a more candid discussion about reform, such as what typically happens in the US. For good or for worse, for better or worse, I do see those discussions in terms of incidence of the corporate tax being a lot more proeminent in the US than I do in other countries around the world. So that's a big danger that I see. But in a way, to balance that danger, even if you don't see a lot of countries picking up on the, jumping on the DST wagon, picking up from the leftovers of Pillar 1, what I do think is that as part of Pillar 2, you do have that idea of the defensive measures. So the beat-like measures or shield-like measures, where depending on where payments are flowing, is it jurisdictional, is it for the foreign group as a whole, that you may end up having the minimum tax charge, not at the foreign parent level, not at the parent level, but at in a disaggregated fashion by countries trying to defend themselves by the absence of the minimum. So the minimum is not there, but maybe the minimum is not there through an immediate intermediary, but it's there because of guilty or because of CFC or whatever. So you may end up having a multiplicity of withholding-like taxes, beat-like taxes everywhere as a means of trying to implement Pillar 2, not only at the parent jurisdictions, at the residence jurisdictions, but in a lot of markets that will view themselves as source countries, and perhaps not so. Perhaps they're just markets. But the point is that I do see that the shockwaves from the globe debate, the Pillar 2 consensus, which is likely to happen, the guilty rules and their potential broadening one way or the other, even at a higher rate, I do see those shockwaves coming, perhaps at least not just for the CFC-like regimes or the full inclusion type regimes for Brazil. Our lives became a little bit harder with this whole debate about guilty getting worse, because then it gets closer to what Brazil does wrongly. But the point is that even worse than that, by number of jurisdictions, I do see this risk of a tsunami of withholding and BEAT type taxes if we see Pillar 2 really becoming a consensus with that defensive measure narrative built in there. One other point, and again on the pandemic effects, right? The absolutely appropriate consideration that there is a need for greater revenues. It was very interesting to me, and I thought very positive that the EU Commission, at least, is acknowledging that regardless of what happens with consensus on Pillar 1, that it still intends to pursue a digital services tax, not for fairness, not to avoid base erosion, but for funding, because the EU wants to set up a budget. It dabbled with a financial transaction tax for a long time. It might be difficult for it to get a chunk of other taxes, but now it openly, confirms that a DST could be a source of revenue to fund Brussels. So in a way, if we at least are that transparent and honest about it, and if, in my ideal world, if you add that to the effective incident debate, then it's a bit more democratic. What do you want to do, to fund the budget post-pandemic or, adversely affected by the pandemic? But that's another angle that I think we all need to consider. I mean, we will be seeing different applications of this in different countries around the world. I mean, it goes from Europe trying to do its own thing. It goes to European Union countries implementing whatever might be the consensus there, but to different countries around the world that don't have the parent. They don't function as the residence countries, but functioning as the BEAT type defensive measures conduit. So very aggressive world out there that I see coming out of this need for greater revenue. Part of it coming out from policy changes influenced by US reform, influenced by the OECD debate. But part of it, as I think we'll hear from our guests, from just pure enforcement posturing. So we will see, as a result of this narrative, and regardless of whether or not the policy initiatives are enacted into law, right? Especially if they don't, then it's one more reason for an increased aggressiveness, especially towards multinational firms. It's an easy target in a world where so much narrative has been built about how unfair the international tax system might be for some. So again, in light of budget needs, we might see that, and that might be a surge in transfer pricing audits. It might be a surge in, expense allocation type audits. It might be a number of different things. But this is where I would like to hear our guests. I mean, starting with, again, we will land in Brazil and back in the US at the end of this debate. But for now, we're still going around the world. We're still going around Europe. So I would like to hear from Meili Franco, who is here. She'll talk about a little bit about the firm she represents, which is French headquartered. And I'm very curious to see how they're viewing the world, how Meili is viewing the world, especially in the part of the world where she's responsible for tax, which is Latin America. So Meili, if you can come in, that would be great.
Okay, thanks, Romero. Thank you, Pam, for your explanation on Biden's plan. Well, let me talk about a brief summary on what we do at Alstom. If you ever use public transportation, you might as well have taken a ride in some of our trains or subways or VLT in Rio, for example. What we do, we are a global leader in sustainable mobility. We build trains, of course, but we are now, we changed our strategy. So we are in the mobility, sustainable mobility, and our mission is to design and develop comprehensive, efficient, intelligent, and sustainable mobility systems. So we do rolling stock, we do systems, signaling services that are all part of tailor-made solutions that we offer to our clients worldwide. We have recently acquired Bombardier Transportation, a Canadian headquartered company, to face the upcoming challenges in the mobility business. So what we do at tender and project phase, we receive the request for proposals from basically clients, governments. So Alstom sets up a project industrial organization, which we call PIO. This PIO represents Alstom's internal organization to execute this project by listing the units involved, their business relationships and missions. So we can have a plant here like we have in Taubaté, which is in the city in São Paulo, that builds the car body shells. We have Santuan that designs the bogies. We have another unit that builds the brakes. So we can then, by this PIO that we built, we can choose what are the parts and components that we will acquire to assemble a train. So it's basically an assembly line. So this, by choosing the units, the participating units, the leading units, the engineering units that will be part of this project, by doing this, we can meet the objective of our corporate model and our freedom of enterprise to conduct business. We are present now in 70 countries, spread around 250 sites across the world. So we have lots of course, how we will build this PIO depends on the business solution, on the platform or the product that we will offer to our clients. But still, I can choose to build a train here in São Paulo or India or in Mexico. It will all depend on costs, logistics, and taxes. So part of the trains are produced separately by the participating units, as I mentioned, and then assembled. In practice, a train takes 1,500 to 2,000 parts and components to be built. And as long as we have all parts together, we can then assemble them in an integration site, like here in Taubaté. We have recently sent the trains to Santiago in Chile. We will build the trains for Line 6, Lines 8 and 9 in São Paulo. We have recently won the bids for that. And later on, we will build the trains for Taiwan and also for Romania. So we are truly a global project company in the mobility sector. So the assembly line is not particularly sophisticated, of course, but it requires a very qualified workforce. Out of the 70,000 employees that we have in Alstom, 17.5 thousand are engineers, and most of them are in, like 20% of them are in India. So we are a technology company, we are an engineering company to design the best trains ever, and secure, safe, and technological. So a very important part of the tax function role is to analyze if the PIO that the operational department sent us is tax efficient. And then we can search for legal alternatives to decrease the tax burden among the various units in the world that we have. So we check mainly VAT, withholding taxes rates, because we do render services to and from the various countries that we are at. We confirm if there are double tax treaties in place. We also confirm other taxes such as custom duties, import duties, special regimes, drawbacks, FTAs, and the like. So we at the tax department, we deliver a tax guidance that will help commercial teams to form their final selling price to the customer. So it's a very, as of course all the departments involved, it's a very strategic part of my daily job. So the internal price calculation aims not only at forming the final selling price, it also aims at applying a standard internal net margin that allows each unit to apply and to get, of course, an appropriate arm's length remuneration. So we have a global transfer pricing policy. We have allocated internal net margins for each of the countries. And then this is to comply with local regulations, with our own global transfer pricing policy, and also ensure transparency throughout costing and pricing processes. So this is what we do at Alstom. We not only build trains, we build a smart mobility. So, and after this brief overview, I can then jump into LATAM landscape. Okay, Romero?
Perfect. Thanks a lot. And I would be very, very curious to hear you layer into the LATAM landscape this let's say, efficiency seeking and it's a difficult market, I would imagine. You're doing public bids, right? I mean, pricing is very competitive. You're not the sole supplier anywhere, even though, as you say, I believe you when you say you're the best. But the point is, if you have to be efficient, if you have to be cost efficient, that means your investment into the different subs that might be taking parts of the value chain is very sensitive to tax differentials. So that's embedded in the analysis that you said. And then policy changes means prospective changes to a business model that you're setting up now and that will be up and running for some time, for years. So very curious to hear, how does your business adapt or react or anticipate policy changes in Latin America?
Okay. So, of course, we are very close to, how can I say, we have kind of a business intelligence, not only for market purposes, but also we are well informed and we are part of associations and institutions and so on. So we have built kind of a tax intelligence, so we can anticipate these effects and then apply those effects in various scenarios to our business. But jumping into total tax contribution for Latin countries, we can say that CIT for our countries or for the countries we operate is not that, I don't want to say it's not that important, but it's not that sensitive issue because we pay CIT, of course, but it's not a tax that we, in Latin America, for our projects, is not something that we dwell with. We struggle more with VAT and withholding taxes. So this that goes directly into the net margin and impacts directly the selling price of the final product. Yes, this is very sensitive. So any changes in that, either be by a new law, like I would mention in Chile with the digital tax in Chile, or the new rule for VAT. This is sensitive for us. Any change in, like in Mexico now, with the tax reform for the outsourcing planning that was held for lots of years in Mexico, this always impacts the way we do business. So a raise in CIT income, I'll go through each, not all of them, of course, but I'll speak on some of the main taxes that we currently deal with. A raise in CIT income, or even a taxation of dividends, or a global minimum tax raise based on income could be harmless for LUM countries at a first glance. Of course, we will need to understand the impacts, not here, but in France, which is our headquarter. Where is our headquarter? Of course, there are some countries that are mainly cost plus sites that are charged with CIT alone because they have cost and a certain percentage, so they are taxed. So this could jeopardize the internal net margin that we have defined for that project alone in a given project. Okay. This would create an extra tax burden, of course. We do pay, now moving on to VAT, we do pay VAT in most of the countries. We just don't pay that in Brazil, but this is due to a special regime that creates another problem for us. We don't pay that, but we have, this creates a specific distortion in credits recovery. But that's another story. That's very particular for the business, not only for Alstom, for the full railroad business. So we pay, other than VAT, we pay labor taxes, we pay custom duties, real estate taxes on plants, and so on. And one other tax that we struggle a lot with is withholding tax, because we render technical services, basically. Technical services, engineering services, so specialized services. which are charged in countries where services are rendered and not always can be recovered. Not always we can offset that in the resident country. So this puts some pressure in the final selling price if not recoverable. So any change in that, any change in the double tax treaty, any change in the local law to withhold more taxes than expected, yes, this jeopardizes the project or the initial tax guidance that we have delivered and that is served to compose the final selling price. So we have to be very careful with the writing of the contracts. We have to be very, how can I say? We have to look very closely if there is a change in law clause to anticipate any change that may give us an extra burden in the contract and then reduce our internal net margin. So everything needs to be checked before we sign the contract. So now going back to withholding tax, it would be much better from a tax standpoint if we could apply the Article 7 and not Article 12 of the double tax treaties, or maybe stop framing services as royalties like we have in France, which it's very comfortable for us because we do have our main site of engineering in Saint-Ouen in France. So this is very good for Brazil. Brazil, as we know, has this rule of withholding 15% on payments sent abroad on services, regardless of their nature. So we need to deal with that. Now, moving on to digital taxes, we are not particularly affected on digital taxes, but some countries, such as Chile, are imposing new rules on VAT over digital services. And the problem there is not only the new rule, but the unclear regulation. The Chilean government hasn't released any clarification or any additional measure clarifying what it is levying taxes on, what it reckons as digital service. So this, for us, we do have some software, we do have some services. So are we going to be affected for VAT? We still don't know that. So this is kind of an unclear scenario. Mexico, as I mentioned, has also approved a tax reform to end abusive tax planning with the use of outsourcing. It's a very old tax planning that Mexico has. And this, if companies do not comply, if they do not adapt quickly, because the law enters in force in August, as of August 1st, then this will have impacts on CIT and VAT. So we have already studied, analyzed the impact, and now we are putting together a step plan to tackle this challenge. So any other changes in Latin America that we have? We have wealth taxes, or in Argentina, Colombia, and Venezuela. We have also high rates on people in Brazil, both for individuals and payroll. So everything combined puts us in a high total tax contribution for all of this, but not specifically for CIT. So when I hear about some tax reforms that focus mainly on CIT, what I think is that, well, this will not affect me closely, but it might. But anyhow, thinking of efficiency, or thinking of how these initiatives can be economically efficient, I don't think I agree with that, because I think that this may reduce investment, or even may reduce long-term plans in any given jurisdiction. So and now just an opinion, if governments need more revenue, they should start by decreasing expenditures. And of course, decrease labor and transactional taxes, especially here in Brazil. We have a huge tax burden with CIT, with PIS and COFINS that are transactional taxes. We have a very outdated table on the payroll of the income taxes for individuals. So all of this combined could we could start by that. So it really worries me to hear about how the Biden's plan of raising the CIT corporate tax could affect other jurisdictions that will just look into this as a mirror, as you said, Romero, but then won't take care of all the other distortions in the tax system. So
That's
this
exactly
kind
right.
of worries me.
That's exactly right, Meili. And it's the old adage, don't in any reform debate, in any tax policy debate, and I've heard this from Penn, and I've copycatted her again, infamous phrases from the U.S. Congress: "Don't tax me, don't tax the fellow behind the tree." Right? That's the best policy to make, is tax someone else. So the point that makes the corporate income tax and then withholding taxes, that's the point I wanted to pick up on in what you said, particularly, let's say, troublesome and distortive, is exactly that. When we see these narratives in the developed world on the corporate income tax, base erosion, and profit shifting, and when we see the narrative around multinationals and their fair share of corporate tax, what this ends up translating to, let's say, to stakeholders around the world and policymakers is they're not paying any tax. And when we actually look closer to an operation that might even be loss-making in a lot of jurisdictions, such as what you were describing for Latin America, that's the least important, I would say, of a lot of different corporate taxes that you have to deal with, and that either affect your investment decisions or your pricing decisions or your labor decisions or all of them. So the point for the region here is that I do see a real danger that a lot of the defensive measures around the BEAT-like taxes, the BEAT-type regimes, the shield-type regimes, might indeed influence a broader adoption of withholding-type taxes everywhere. And let's see how that plays out even with the UN model, right? I mean, Brazil has had its vision and India has had its vision of broadening the definition of what technical services and services that fit under Article 12 might be, and very creative and very distortive also in a lot of ways. But the point is that that type of position gains strength. You need revenue, and you have a narrative about how to reach the big bad multinationals. Withholding taxes are an easy way to get there. So this can be really distortive on value chains, such as what you have described. But with that, I think that there's a point there that goes beyond policy and that we start to get into, which is really enforcement and transparency. And with that, I wanted to hear from Patricia. Patricia, moving from a French multinational, now let's talk about a Brazilian multinational that has a very rich history and that actually is let's say now carries the legacy of U.S. multinationals. Actually, one of them formerly headquartered in Michigan, where I used to live, and that has a very interesting and very peculiar set of issues that actually is not that peculiar, that ends up being replicated by, in a lot of firms. So let's learn a little bit more about Yoshpi, Maxion. Patricia, if you can talk to us about enforcement and transparency, and how is this whole shift in the landscape and need for greater revenues affecting not just the policy making in terms of the legislative development, the administrative policy making in terms of compliance and enforcement.
Sure. Hi. Before I present my comments, I just wanted to present Yoshpi Maxion. So Yoshpi is a global public traded company. We are a Brazilian multinational listed in the Brazilian Stock Exchange here in São Paulo. We have 31 manufacturing units in 14 different countries. We are the leader in automotive wheels, in the production of automotive wheels, and also in other automotive auto parts, structural components. So if anyone here drives a car, they probably have one of our wheels. Now, what I wanted to bring here is, what I wanted to comment is, in addition to Pillar 1, this tax reforms that we've been seeing, the discussions on Pillar 2, is in this context of increase in tax collection is what we've been seeing in globally. So what we been seeing is that tax authorities nowadays, they are indeed having a closer look to compliance, so on a daily basis to compliance and to companies' operations. And that actions definitely influence our business decisions. Being present in Europe, in many countries in Europe, in the Americas, and in Asia, what we see is that in all the Latin America's countries that are OECD members, that transparency has increased significantly in recent years. And let me bring here some examples to illustrate that. I think the first one was the implementation of DAX 6 in Europe and the corresponding reportable schemes in Mexico, for example. These are evidences of how countries are fighting the reduction in tax burden and, of course, then trying to increase tax collection. For those who are not that close to Europe, DAX 6 is a European directive that applies to EU headquartered companies, and they introduce reporting obligations of a wide range of cross-border transactions. And the purpose of DAX 6 is, as I was saying, is to enhance transparency. As you can imagine, if a company does not comply with the reporting obligation, it will face penalties, sanctions. But I think most importantly, this will represent a reputational risk to businesses. So this is definitely something to be attentive to put a lot of attention to. The issue here with DAX 6 and also the reportable schemes in Mexico, for example, is that they set very broad characteristics to the transactions that need to be reported. So that includes, for example, the conversion of income into capital, cross-border intercompany loans. That happens pretty often in multinationals, right? So not intercompany loans that, for example, include round-tripping of funds, and of course, transfer of functions, risks, and assets, as well as, for example, hard to valuable intangibles. So these are examples of transactions that may need to be reported, and on multinationals, these kind of transactions may happen quite often, especially intercompany loans, cross-border intercompany loans. So now, besides being diligent and compliant and having to build the benchmark studies to determine, for example, the intercompany interest rates for intercompany transaction, we need to take a step further and also analyze if these kinds of transactions that we're trying to put in place could fall under the reporting obligations and report them. If the company comes to the conclusion they are not reportable, then we need to make sure that that we have proper documentation to sustain the position of not reporting it in case of a tax audit. So to me, DAX 6 is a clear sign of the closer attention and close monitoring of tax authorities in this new scenario of compliance and tax collection. A second movement in this direction is the horizontal tax monitoring that is being discussed in Europe. It's an agreement. It's an agreement between tax administration and taxpayers in which they agree to cooperate on an ongoing and a regular basis. That it is a voluntary procedure, so taxpayers may apply to be part of this program. They are focused on large companies, and they definitely require rigorous documentation, internal controls, and compliance. This action also, in case one company decides to take part of this program, it needs to make sure that any past tax problems are solved. And by entering this agreement, both tax authorities and the taxpayer, they agree to cooperate based on transparency and trust. So here again, transparency and trust. I remember when, and just to summarize how the horizontal tax monitoring works is, it means a different type of tax enforcement. In a traditional tax enforcement, the actions begin in the end of the chain of obligations, meaning the companies file the income tax return and then questions, correctness, they may follow afterwards. Now, in this type of tax enforcement, it starts in the beginning of the chain of fiscal obligations. So it's a continuous interaction with tax authorities. So when the taxpayer files the income tax return, potential tax assessments will simply confirm what was already in the tax return. I remember when Austria published their project for the horizontal tax monitoring. They presented the objectives of the program, and two of them caught my attention, and I brought them here. One is that one objective was to foster tax compliance, and the second one was to ensure legally valid and timely tax collection. So that's clear that this practice on a daily basis, besides the discussion about tax reforms, digital tax, the taxes that we already have are being watched more closely. The third one that I wanted to share is the public country-by-country reporting. Very recently, about 1 or 2 months ago, the EU announced the intention to expand the compliance requirements for the country-by-country report. As you know, the EY directive applies to EU headquartered companies with consolidated net turnover exceeding 750 million euros in each of the past 2 financial years. The news here is that for the non-EU headquartered companies that have EU presence, they would need to publish the required information on their website and assign one EU subsidiary or branch, if that's the case, to file such reports in the trade registry in their member state. Alternatively, if the non-EU headquartered company, such as my case, a Brazilian multinational or any US headquartered company, if they decided not to publish this information on their website, this publishing and filing obligation shifts automatically to the EU subsidiary or the EU branch. So these are, to me, clear actions from, and just to conclude, these are clear actions from how governments are acting more actively in terms of decreasing tax avoidance and consequently ensuring tax collection.
That's very clear, Patricia. And I think that the subliminal message there that concerns me is actually lack of trust. So when we are faced with the budget issues that we face, and instead of having the open, as Meili was bringing up, the open dialogue about, who's going to pay the bill? Are we going to revisit personal income taxes, capital gains tax? At least in the Biden discussion, that's on the table too. But instead of having those discussions, it's much easier to point the fingers at multinational firms, even those that are not in the Silicon Valley, even those that are in infrastructure such as Meili or in auto parts, which is an extremely tight margin business. And these firms, which is the majority of multinationals, is subject to, let's say, mechanisms that demonstrate perhaps lack of trust. So if you want me to trust you, you have to be more more transparent, you taxpayer. You have to open up what you're doing ahead of time. You have to come up with new processes that prove to me that you're trustworthy. So then I can trust you. So even in the countries where those mechanisms are in place, I do see this issue of the potential erosion of trust. You know, if we went through the BEPS process for base erosion and profit shifting, now I think it's more trust erosion and blame shifting in one way or the other. But as we think about that, I wanted to hear Bruna. Bruna also has tremendous experience in dealing with different jurisdictions, different parts of the world, and different countries interpreting tax treaties. And I think that on this issue of trust, and on this issue of how to build trust in the wake or while we're going through the pandemic with the need to raise revenue, how do you see multinationals in that space, Bruna? What is the role? What is it fair to expect, or what would be the right debate around fairness?
Thank you, Romero, and thank you for the invitation. So just to give an overview of Klabin as well, very quickly. Klabin is a leader of packaging paper export, as a leader packaging paper exporter and also producer in Brazil. And we have a very sustainable way of production because of the forestry and so on. So kind of most of links to all the pulp and paper companies in Brazil. So just to give you an idea of the whole operation, we operate in most of the Brazilian states, and we have also subsidiaries abroad, mostly in Europe and in the US, and also in Latin America. So Romero, just taking what already you have mentioned throughout the whole panel and then summarizing it when it comes to tax fairness, I'm just going to do a summary. And I would like to just to come to my main arguments, and I would like to point out some special 2 points actually. The first one is that what we could expect in terms of restriction of the rules that are already in force, either in Europe or in Brazil, and maybe we could come back to Brazil later, and then a little bit about tax morale and how do we incentivize, or how we make taxpayers comply with tax obligations, and also their willingness to pay taxes. I mean, I think this is the biggest issue in the end. It's the basis of any tax system. So as you all have already mentioned, the pandemic has led the governments across the world to increase spending quickly and substantially. And in response, I think that the budget deficits that the countries are incurring, policymakers now are already considering what revenue sources could provide the necessary funds. And however, it seems to me that we are looking at a lot of creative possibilities and new taxes and new ways of establishing minimum global taxation, etc. It seems to me that it's more important, or mostly we would need to analyze first the capacity each tax already foreseen in each domestic legislation has of raising revenue, both in a weak economic and growing out of it. Because if we look already at our tax bases in Brazil, for instance, we do have a lot of indirect taxes. We do have a very high corporate income tax rate. So is it necessary to have a new tax? So would we be talking about a DST in Brazil, or at least, I don't know, an increase of, or a wealth taxation or something like that? So I don't think that is the way to go. For me, it seems that it needs to be taken into consideration the additional burden a new taxation would bring to taxpayer, or a broadened taxation, and how that would affect economic recovery and the distortion it could cause. Because as everybody knows, any tax cause distortion in the economic environment and so on. So if you would have the increase of the tax rate or broaden the base of indirect taxes, probably it would influence demand and supply. If we increase the taxation over income tax and net wealth, probably then we would increase the tax burden for investments and so on. So this is a very tricky balance that the policymakers need to make. And I think that for now, countries will need to spend time, and mostly I think they are doing that. Even in Brazil, we are discussing tax reforms for a long time, and sometimes we don't believe in it anymore. But we need to spend time reviewing how the tax bases are designed. It needs to be, I think what we need to do is match the capacity each tax has of raising revenue in a determined country with, or the taxable capacity with the effectiveness of that tax collection. Because I think what we have nowadays is that probably this tax could, we could have a better collection of taxes with the taxes we already have. Probably we are not achieving the full potential, the revenue potential these taxes could raise. And in order to get there, I think tax morale is very important. And then also, how would we increase the willingness of taxpayers to comply with, to have a corporate compliance, to have a voluntary disclosure, and so on. And if we go to that specific part, I would say that in Latin America, we do have a basic problem or a fundamental one, and we would look not just in Brazil. Today, actually, I joined OECD for a debate about tax morale. I told you about it, and it was amazing to see that all the Latin American countries had the same problem. We do not have a tax certainty. And for us in Brazil, I think that's the biggest issue. We need to increase tax certainty via more collaborative understanding of the law, avoiding deviations with interpretations that either expand or reduce its applicability. Because nowadays we tend to spend more time discussing and litigating about what is the tax basis, what we should actually pay, if such operation is subject to one tax or another, and etc. Instead of actually collecting this money to the tax authorities, or instead of actually building a trust relationship between tax authorities and taxpayers. So it's not efficient at all. I think we are always spending time with discussing the basic grounds of each tax. It goes from direct tax to indirect tax, domestic legislation, international standards, how they are aligned to domestic legislation, and so on. And if we talk to any multinational company, especially Brazilian multinational companies, we would see this is the problem. I mean, the problem is not, of course, we do have a high tax rate, but the thing is, we don't even know sometimes how do we collect everything, and if we collect ICMS or ISS. That's the problem. The problem is the understanding behind the legislation, which is already in force. And sometimes I think that, not sometimes, most of the times, I would say that we would need a better discussion or consultation between tax authorities and taxpayers before issuing regulatory instruments, for instance, legal binding opinions or normative instructions and so on. So we would need to actually have a prior public consultation, for instance, or more debates with the society, because then we would avoid all the discussions that are originated because of this lack of trust, lack of discussions. And this, of course, decreases the revenues that could be collected. I think this is more an overview of Brazil, Latin America. Also, there is, as Patricia mentioned, a lack of tax transparency. And I would say nowadays, clearly, and of course, anybody can comment on that, but I would say that we have much more tax transparency from taxpayers nowadays than from tax authorities. I mean, if we look at how many information we give tax authorities, how many hours we spend fulfilling ancillary obligations and so on, and for what this information is used for. I mean, is it accurate enough? For what are they trying to analyze? Sometimes it seems that we are giving a lot of information, but maybe it is not the information the tax authorities really need, because if it was, then they would already have a disclosure. We wouldn't need a DAX 6 rule, for instance, in Brazil. We already have a disclosure of almost everything. So this is a point which we also need to understand. I mean, I think tax transparency should work from both sides. And I don't know if it's just a problem in Brazil or Latin America. I think maybe it's a problem everywhere. Because what we want to understand is what is being done with all the data we are providing. And in the end, also, I think a very important tool in building trust, in building a good environment, and then increasing revenue, the raise of revenue and collecting revenue is using a very important tool that we actually don't have, or it seems that we don't have, or we don't see it, which is mainly in Brazil, which is what tax policy, going from direct to indirect taxes or any new taxes. I think the balance will be set on what the government wants to encourage. Tax policies that constrain, for instance, investments and hiring will increase the long-term economic risks, for instance, and the recovery. And I mean, what do we want to encourage? Because you need to choose something. Either you increase or you broaden the tax basis for indirect taxes, or you increase or reduce direct taxes, or you impose a wealth tax. And what do you want to encourage? I think this will be the balance, because in the end, you need to choose something. It's impossible
to. That's a great point, Bruna.
Yeah.
That's a great point. That brings us home, I would say. We went around the world. We've actually did a high-level review of what's going on in different parts of the world, in different geographies of our tax systems around the world. But in the end, we do have a timing constraint in terms of what needs to be done given the pandemic. We need money now. Countries will need money sooner rather than later. It's imperative because of what has happened given the pandemic. And to shift tax morale and to shift tax cultures is not a short-term exercise. So if you really go down the path of keeping to pursue interpretational and enforcement avenues that might actually erode trust and might actually trigger more uncertainty, less investment, more litigation, more expenditures, it's counterintuitive. You don't get the revenue and you don't get the growth. At the same time, if you need the revenue now, and that's not the angle, where is it? And I do want to hear Pam a little bit more about the prospects of personal and capital gains tax changes in the US before I bring it back to Brazil and we do a wrap up on what might happen in our world here. So Pam, how about personal income tax rates and capital gains regimes? Are we still going to be living with preferential regimes for capital gains? Are we going to start taxing unrealized gains? What's the story there?
Very good question. And I wish I had a clear answer, but my crystal ball is not telling me what the answer is. I mean, right now under the law that was passed in 2017, the individual changes were enacted on a temporary basis. So we had a 39.6% individual rate at the top. That was dropped to 37%, but it only lasts until 2025. And then 2026, it goes back to 39.6. There was also a preferential regime put in for small businesses. Small is not really the right word, but pass-through businesses, partnerships, S corporations, businesses that pay tax at the individual level. That takes another six or 7 points off the rate. That also sunsets in 2025. So right now, the rates are going to go back up regardless, but there is don't tax me, don't tax the rich fella behind the tree, or tax the corporation across the sea. That's clearly the mantra. There is a very strong desire. It's interesting when we have conversations about competitiveness. Competitiveness has been redefined. So if we talk about competitiveness now, it means that we've got good infrastructure, and that means you've got to spend more, and that means you need to collect the money from corporations to spend more on the infrastructure. On the individual side, it's all about fairness and the view that rich people aren't paying enough in taxes. And, it sort of doesn't matter what kind of statistical evidence you give them that says, oh, that's not really true. They still come back to this idea that rich people aren't paying enough in taxes. So, current capital gains rate is 20% plus a 3.8% net investment income tax, so 23.8% all in. The economists tell us that there is a, quote, revenue maximizing rate, close quote. That revenue maximizing rate is like another 4 points maybe. So maybe we could go to 28%. But if you go beyond that, then the economists say, well, you're going to start losing revenue. And the only way to because people won't sell their assets, right? They'll hang on to them rather than pay that greater amount of tax. But so the way to get around that is to do a mark-to-market regime. And if you do a mark-to-market regime, in theory, you could take the rate to whatever you want to take it to. As a practical matter, there's a lot of resistance to that among the farmers, which are still an important constituency in the U.S., to small businesses, which are a very important constituency in the U.S. And so, it's hard to see it going, there being a market-to-market system and the rates going up a lot higher. I mean, the other problem, of course, is, if you look at mark-to-market, that means I still hold the asset, but I've got to, pay a chunk of change over to the government. Where do I get that chunk of change? And then, if you're going to have a system that's rational, it means that when the market goes down, the government ought to be cutting you refunds. Well, that's not going to be popular either. So I think there's a decent chance that capital gains taxes go up some, but I don't think they're going to go to 39.6%, or that we'll have mark-to-market to take things to 39.6%.
That's a great point for us to land here in Brasilia now, because basically the debate in Brazil has been absolutely upside down. Basically, we've had all kinds of discussions around consumption tax reform for the longest time, for the last 30 years. In the last 3 some odd years, that discussion has been more qualified. We have quality proposals going around and everything. But at the same time, not enough has been debated around income taxation in this country. And we do have all kinds of distortions, both on the corporate side as well as on the personal side, in the fund industry, and all kinds of different angles that you look at. There are distortions. There are overly taxed people and segments and under-taxed people and segments everywhere you look at in this country. And if we think about it from that angle, and knowing that in Brazil, for example, we already are super taxing consumers and consumption. We are already, as it was mentioned by Meili, super taxing payroll and workers in that angle. There's nothing else to look at, if not some way, shape, or form of the income tax. It's interesting you say, and I completely agree with you, that when we think about the potential capital gain tax reaching unrealized gains, what are we doing? It's a wealth tax in one way or the other. So do we really want to go, as the OECD is now preaching, do we really want to go down the path of revisiting wealth taxes? It might be, but I completely agree with you, Pam, as long as we have a negative tax system being able to be implemented in one way or the other. Some carry forward, some carry back, whatever you want to do. But the point is that that's a healthy debate, especially the personal income tax debate. That's also a healthy debate. And in the case of Brazil, given how much harm we've done to firms here, with now, I think, the highest rate in the world, the highest rate in the G20 for sure, even higher than France. I mean, I see people trying to do the math there and coming up with Brazil second or third. No, Brazil is first. And basically, the very high nominal rate we have was fixed when the US federal rate was 35. So we fixed our rate initially at 30, then it crawled up to 34, but it stayed just below the US federal rate, so that we would have this impression of competitiveness in whatever definition of competitiveness you want to use. But then again, what we did with everything else was a nightmare. So withholding on a very high rate, gross payments of any kind of things, so a blockage of the trade of services, a blockage on the importation of know-how. And now in the middle of this, let's say, of this disaster, where we do want to revisit the income tax world and perhaps learn from the experience of other countries who have been trying to fix the income tax for a longer time, we see the digital debate, in a way, contaminating the discussion in Brazil. We've seen different proposals popping up of a new specialized digital services tax when we already have, in fact, a whole host of transactional taxes that overtax digital services and other services and technology. And at the same time, we see the same type of risk that we're facing here in Brazil going around everywhere. I wanted to hear the panel a little bit, but I think one of the main points here for Brazil is we need to unleash investment in this country. We need to foster job creation in this country. And much as Pam has commented on the policy now shifting from tax policy to growth, it's actually a dispute over the factors, over the production factors, right? I mean, if we move from B to shield, whatever, we're now thinking about production sites. If it's COGS, we're thinking about production sites. So we in Brazil and policymakers in Brazil are not at all focused on how tax impacts foreign direct investment and trade and productivity in this country. And if we don't use the moment of reform right now to ease up on the investment front and line up the Brazilian corporate rate to what might be a median in the developed world that has better infrastructure and better human capital. So if we don't line up at least on that angle, we're doomed. I do think, though, that the debate must be engaging in the sense that it must be clear. We cannot let the public opinion be misled by the news that comes out of Washington, D.C. So if the Biden proposed rate is 28, we've heard from Pam, we don't think it's likely it's going to go above 25. Of course, there's a risk, but not very likely. So the Brazilian debate shouldn't be influenced by the 28 rate. We heard from Mei Li here how the different withholding taxes can affect her investment decisions and locational decisions. So Latin America countries, African countries, Asian countries, developing countries around the world, don't be fooled by the BEAT-type taxes in defensive measures under Pillar 2. Avoid the wave of withholding taxes and similar rates because it can hurt your economy. So I'll stop here, and we can take questions from the audience too. A few have come in, but I wanted to hear the panel first. Eager to hear the three multinationals we have sitting here on both their views on whether the personal income tax and capital gains tax, whatever, might be the answer to the revenue needs, and whether they would agree with me that we already are overtaxing firms in Brazil and we need to do something about that. So, Mei Li, do you want to take the lead?
Yeah, I can go first, and I'll be very quick. First off, we don't mind paying taxes. We understand it's part of our corporate responsibility, and it's a way to give back to society. We pay taxes on profit, on people, product, property, planet. We pay environmental taxes in the UK. Our global ETR, is 27%, and our tax cash out this last fiscal year was 94 million euros. This is a public data. That's why I'm sharing. So what I think is using the tax system to interfere with well-established models of corporate ownership. This may discourage risk-taking. This may harm the freedom of enterprise principles. So if governments need more revenue, they should start, as I said before, by decreasing their expenditures, decrease labor and transactional taxes, or maybe find a balance in between what they need and what they can charge, thinking about investment. So they could give tax incentives that are beneficial on the long run, and not only for sectors that always disbalance one and another sector of the economy. All of this combined, of course, this is not a cake recipe, but all of this combined, plus other economic measures in the safe legal environment, or the tax certainty that Bruna mentioned, can all increase investments, create jobs, generate more revenues, and ease the burden on taxes. So this could be my final remark for this.
Very clear, Mei Li. Patricia, your take, especially focusing on what might happen or what should happen, at least to be technically right here in Brazil.
Yeah, I also have brief comments. I agree with you, Homero, that we are overtaxed here. I agree with the movement in the direction of reducing CIT in Brazil and increasing withholdings. Therefore, we move the taxation from production to the end of the away from the production. Now, I think we are, especially from a Brazilian multinational perspective, just to point out that we have CFC rules in Brazil. So that increases our effective tax rate. And this CFC is completely unusual. It's not the CFC that many here may know, this international rules. It's something very particular. And this is something that really needs to be addressed. We're not taxing only tax havens or low effective, low tax jurisdictions or countries or companies that have very low effective tax rate, but we're taxing everything. Right?
Active
so
income.
This, our active income, correct. So I think this should be definitely addressed in Brazil. And I agree with Meili that government should reduce expenditures, for sure.
Bruna, your take.
Thank you, Romero. Yeah, I mean, I agree with everything that has been said, mainly with what Meili said about reducing tax expenditure. There are two ways of reducing the deficit, right? Maybe increasing revenue or reducing expenditure. And we are always, it seems that we are always discussing only one side of the equation. So, of course, we need to look at both. And but I really think that when we think about corporate income tax, it's not just about reducing the nominal tax rate. It's about talking about effective tax rate. This is what needs to be analyzed. This is what a tax reform should be looking into, because it doesn't matter if you reduce or increase the tax rate, but you broaden the tax base. I mean, I think. Yeah, sorry, I thought it was. So I think this is the main point, as Penn said, about the reform also in the U.S. So you can say that you reduce your nominal tax rate from 34, as we nowadays have, to 20%, and then you broaden the tax base. So in the end, the effective tax rate will be the same. So it wouldn't change. I think that what we need to look at, and that has been my main topic. And a lot of events that I've been talking about this is what is Brazilian tax? What is the tax policy of Brazil? Because I mean, what do we want to encourage, and how do we reduce inequalities? Because there is we cannot just say, of course, that, okay, I want to encourage investments abroad, but then I need to increase the indirect tax bases, and then we increase inequalities as well. So the equation is difficult, but we need to analyze how we do that so that we don't block investments that need to be performed abroad, to have growth, investments that need to be performed in the country as well. But also we need to measure how we are impacting indirect taxes as well, because nowadays it's also unsustainable. And I think one point of why it is unsustainable is because actually we don't have efficiency in the taxation. We don't have an effective collection of the taxes, because we are discussing everything. We are discussing what is the tax basis of contributions. We are discussing what are the credits we can take in a accrual of taxes. So just to put that, I think mostly tax uncertainty. We need to have a better scenario and about the taxes we already have. I mean, we need to have a better understanding and alignment of what we're taxing and how.
Fully agree. And with that, we're 3 minutes over time already. And I apologize for going a little bit over time, but it's just for me fantastic to hear this wonderful group of speakers here, this wonderful group of women that I very much admire in our tax world. And with that, I will adjourn the conference. We did have a few questions, but I do think that the comments we've made already covered the questions that we've answered. But if not, please feel free to reach out to your local PwC contact in wherever country you're in. And we will be happy to talk to you about the current landscape and what might the future hold for us. So thank you very much, Pam, Meili, Patrice, and Bruna, and thanks to all in the audience here for being with us today.
Thank you, Romero.
Thank you.
Thank you, Bruna. Thank you, everybody.
Thank you, everybody. Thank you.
Bye-bye.
Bye-bye.